Hi, in this problem we're going to work on a flexible budget, and we're going to look at the two main variances, one being the activity variance, which is volume related, and then revenue and spending variances, which are dollar values related to revenue differences and spending or expense differences. In this picture, or this pizza company, Verona Pizza, we see a table of cost data, and you can see that cost is both fixed and there are variable components. A little complexity is added in that there are two variable components. So the cost for this company will basically be, their variable cost per pizza plus their variable cost per delivery plus fixed costs. And they're going to look at whether or not they're going to make a profit or not. Their anticipation was that they would sell 1,500 pizzas at an average price of $13 and that they would have 200 deliveries. Their actual results for the month of October are shown below. The actual results I have put into a table, our flexible budget formatted Excel sheet. So those values with 1,600 pizzas and 180 deliveries, the 21,000 of revenue, and all their cost data. I already computed the net operating income based on revenue minus my total expenses, which provides me with my income. What we want to do is create the flexible budget, which the flexible budget is based on the actual quantities, but it uses the cost formulas that were generated during the planning stage. They did not give us a planning budget, so one of the things we're going to need to do in order to calculate activity variance is going to be to calculate the planning budget. So we're going to take that cost data at $13 revenue per pizza, and we're going to start doing the multiplication. I'm going to take those 1,500 and I'm going to multiply it by $13. I'm going to work my way all the way through the planning budget before I work on my flexible budget. What I want to do is I want to see what my profit goals were. So now I'm looking at the ingredients. It was supposed to be $4.20 per pizza. So I need to multiply it by the 1,500 pizzas. Kitchen staff was given to me at a fixed cost. Fixed doesn't vary with the quantity over a relevant range of activity. It stays the same in total. In the utilities, you can see that I have two cost formulas there. A part of the cost is fixed, we turn the lights on, and a part of it varies based on the number of pizzas, the letter Q here, quantity. So I want to take 10 cents per pizza, my 1,500 in the planning budget. You in your head hopefully know that that's going to be $150, but then to that amount I want to add the fixed $5.90. And it totals $7.40. Delivery is contingent on the number of deliveries we make. Okay, now again, we are in the planning stage only right now, so we expected 200 deliveries at $2.90, average delivery cost $5.80. Likewise, the delivery vehicle costs. I'm going to take $1.30, multiply it by expected 200 deliveries, and then I'm going to have to add the 610 of fixed cost. Depreciation tends to be a fixed cost because it doesn't change based on the number of pizzas and number of deliveries. Depreciation is the allocation of cost over expected useful life. Okay, so it tends to be fixed, just like the rent is fixed. And the miscellaneous expenses again has two components, 5 cents per pizza, 1,500 pizzas, plus a fixed portion of $7.10. I'm going to use the Excel function key called the summation to add the 6,300 all the way to the 785. And then my next step is I'm going to take my revenue and I'm going to subtract the total of those expenses to see what my net operating income is. And I have a little check figure here and we match. Okay. So the flexible budget, it's got a formula in here to look at, not sure. So what we want to do with the flexible budget is to take our actual quantities 1,600 pizzas, 180 deliveries, and use these two variable components and recalculate the planning budget had we known that we would have had these activity levels. So had we known we were going to sell 1,600 pizzas, I would have multiplied it by an average revenue of $13 a pizza. Right? So again, I'm going to go through the whole routine where I'm going to take $4.20 of ingredients for 1,600 pizzas. And the kitchen staff is a fixed cost. It doesn't matter how many pizzas or how many deliveries, it is entirely fixed. Okay, again, in this particular utilities, I'm going to have a combination of both. I'm going to have to take 1,600 pizzas, multiply it by the 10 cents, then add my $5.90. Fixed cost. Now, we've changed the variable here. This is based on deliveries. Okay, so I want to take $2.90 in delivery cost per delivery and multiply it by 180 deliveries. And the delivery vehicle, same thing, $1.30 times 180 deliveries, and then to that add 610 of fixed cost. And I'm going to add that other parentheses, order of operations. Equipment depreciation we said was fixed. $17.90 of rent is fixed. And then lastly, the miscellaneous expenses are going to vary at 5 cents per pizza. And then we want to add the fixed $710. So again, I'm going to use the Excel auto sum feature, select my range, subtract my total expenses from my revenues, and I want to check my check figure, and it agrees. Yay! And of course the actual results, we can't change that. That was a given number for us. But now what we're going to do is we're going to calculate the variances. To focus on the activity variance, we are going to do a subtraction between the flexible budget and the planning budget. This gives us an indication of how much revenue differs as a result of the activity variance of having 100 extra pizzas that we sold. And we did 20 less deliveries. We didn't do as many as expected. But it really didn't impact us in total. Our revenues, okay, still exceeded what the plan was. And that's always a good thing. This is a revenue number. So it's going to be a favorable variance because our revenue is higher than the plan. Okay, that's not the case when we hit our expenses. When activity tends to be higher than the plan, costs tend to go up too because we created more pizzas, we worked longer hours, and the whole gamut of different expenses. So if I look at this, I want to take the 6,300 anticipated costs and subtract the flexible budget amount. So I'm doing the subtraction between the two, and this is going to be marked as unfavorable because the flexible budget actually shows that we're going to spend more than the plan. Right? Now, this next one, if I'm going to take my plan, $58.70 of kitchen expenses, remember that the flexible budget was based on the plan. So the flexible budget is still a budget, not my actuals, okay? So essentially what I'm doing is I'm just doing the subtraction, taking the planning budget and subtracting all my flex numbers, 580, 522, delivery. Deliveries, I would expect it to be less because I have 20 less deliveries. Okay, delivery vehicle should be less because that again is based on 20 less deliveries. Right? So my marking here is going to be unfavorable when my flexible budget is higher. That means more cost under this scenario. Okay? Here the cost is less, so that's going to be favorable. And likewise here. And I could put in none, but there's really no need. There's no variance on these because it came out exactly the same, and those happen when you have a fixed cost. The last one, again, is going to be unfavorable because the number of pizzas increased over the planning budget. Again, if I do a summation, okay, you can see that in total my costs are unfavorable. It is expected it would be unfavorable because of just the volume component. Now, when I take my revenues and I subtract the 351, okay, 1,300 minus 351 takes me just under 1,000. It's still favorable. So the revenue increase offset my cost increases, which you would hope would happen. And so the activity variance ended up generating profit. Okay, those 100 extra units generated $949 of extra profit for the company. Now what we want to do is compare the flexible budget with how we controlled our costs. Well, we know there's not going to be any quantity differences here because obviously the flex is based on the quantity. What we need to do is we want to take our revenues and we're going to subtract our flex. And I did the revenue minus the flex first because I see that we are favorable in that we sold the selling prices were higher than the $13. Okay, now how do I know that? Well, I could take 21,340 divided by 1,600 pizzas, and you could see that the average selling price was $13.34. Again, that's an average. But I could tell that we were higher by the fact that we made 21,000 versus the 20. Okay, likewise, I'm going to have to take my cost data. Now this time I'm going to shift. I'm going to start with the flex budget and then subtract my actuals. Right? So this is the plan against which I want to operate because it's based on this level of activity. But we spent more. If we spend more, that's going to be unfavorable. Okay. Likewise, I'm going to do the same thing with the rest of these. The $58.70 of kitchen staff fixed expenses, we only paid $58.10. So if we built in a budget of a rate increase or a little bit of overtime or a new hire, we actually came in a little bit under budget. Right? So this one will be favorable. Favorable because our cost was less than planned. $750 was the plan for our utilities, and we're over. Now we might want to investigate why we're over. We know it's an unfavorable variance. It could be outside factors like the utility prices increased, which we don't have control over that. Okay, but it could be internal factors like, oh, we forgot to shut the ovens off. They ran all night, or, we left the lights on and, the whole week and we forgot to turn them off, and so our electricity bill was higher. Okay, again, I can come in and put in none, unfavorable, depending on what the variance is, none, because there is no difference, and again, that's typical when there's a fixed expense, but it doesn't always the case, right? And in this case, again, we're favorable, okay, because we're a little bit under plan on the miscellaneous expenses. I'm going to go back to the auto sum feature in Excel, add up all my costs. My costs are not favorable, okay? I only have the 72 favorable, offset by over 300 in unfavorable costs, netting 321 unfavorable. So again, normally I would just take 540 and subtract 321, but because I have it bracketed in Excel, I actually have to add it because I'm adding a negative number. Okay, so in total this was unfavorable, again the negative bracket, but we had 540 of favorable revenue variances, right, that offset some of this unfavorable cost, so the net impact was that it was favorable. Now just one last thing, and that's to look at the total. Had we compared our actual results to our planning budget, you can see that we actually have quite a huge difference, and we would see that we actually exceeded plan by 11